Hey everyone, welcome to the E-commerce Playbook Podcast. I'm your host, Richard Gaffin, Director of Digital Product Strategy here at CTC. And I'm joined today not by Taylor, as per the usual, but rather by somebody who's in the front lines every day here at CTC, managing our growth teams. Well, Taylor and I sit in our ivory tower. We're joined today by a very special guest, Luke Austin, who is our Growth Strategy Manager here at CTC. Luke, how are you doing?
I'm doing great. Long-time listener, first-time guest, as they say. So happy to be here.
That's right. Long time, first time, a broadcast classic. Yeah, we're happy to have you too, man, particularly because I think you've recently had an insight that you've been tweeting about a couple times over the last couple of weeks that has been pretty crucial, I think, in terms of the way we're thinking about how the macroeconomic environment, or rather the macro e-commerce environment, is going to look like over the next quarter or so. We can jump straight into this. So you tweeted, let's play a little game of defend that tweet, so to speak. So this was May the 5th, which is at the time of recording was last Friday. You tweeted a tweet, which is actually a follow-up to a previous one. But essentially the gist of it is this, that new customer, or rather returning customer revenue, is at a relatively low ebb. And specifically, it's the lowest Q1 year-over-year growth in returning customers that we've seen in the past 4 years. Which, of course, suggests something troubling, which if you have been listening to this podcast, you'd be familiar with the concept of the shrinking sponge, the idea that if you over-index on engaging, or rather growing returning customer revenue at the expense of acquiring new customers, you'll get to a point where eventually you run out of returning customers. So what this particular data point suggests is we're now at the tail end of that process, where suddenly new customers that should have been returning customers this quarter aren't there. So the returning customer, or rather the sponge, is relatively dry, which is problematic. So maybe, Luke, you can sort of speak to that a little bit. Like, how did we find ourselves here? What's playing into that? What's going on?
Yeah. And I think this is so important because returning customer revenue is the highest margin revenue that there is, right? New customer revenue has, for many of our brands, a lot of implications on the cost side in terms of the customer acquisition cost specifically. And so as brands are running into cost constraints, the decline in returning customer revenue, I think, is super important to identify what's going on specifically. And so I guess maybe to take a step back, even before this year, we zoomed out over the past few years across our data set. So it's about 3 billion in D2C revenue, hundreds of millions of spend, and try to understand what's been going on in the broader landscape within the context of our data set. And so returning orders so far this year are flat compared to last year across the data set as a whole. So what that means, we're looking at Q1 2023 compared to Q1 of 2022. And we're saying returning orders and returning customer revenue is flat. There's no increase at all. For some brands, there is an increase in returning revenue, even though returning orders are down. That's mainly due to AOV and increases, people raising prices. But the returning orders piece is the important one to focus on. If we look back at last year, what we saw across our data set was new customers were flat. There were some quarters where actually new customers in 2022 it was a decline compared to the prior quarter in 2021. But aggregate last year compared to the year prior, new customers were flat. And so what we're starting to see here is the reckoning of that decision, right? Mm-hmm. For a number of reasons, which we can dive into, brands decided not to acquire or were not able to acquire as many new customers last year compared to the previous year. And the results of that decision is reckoning right now in the returning customers being flat, because that's the trickle down effect, right? That is the sponge that is being squeezed.
Right. So you mentioned some of the reasons behind why that decision may have been made. So let's get into some of those right now. Obviously, there's the general sort of macroeconomic doom and gloom that's been part of the conversation for the last 6-7 months now, or maybe more than that. But what's your take on the reason behind some of that decision making, and why do you think we're in the situation we are now?
If I were to say one reason, would be the perpetual focus on year over year comps, specifically in revenue. And so that's been something that has continue to be a focus for brands just, yeah, wanting to see revenue comps year over year and increasing that. And so, what I think happened, or what we know happened, is in 2020, there was massive new customer growth. So, that same chart and that tweet shows the new customer year over year growth in 2020. And it was massive, right? The COVID arbitrage, a lot of brands grew their new customer portfolios really significantly. And so, the year following, in order to comp up to that, brands needed to spend more, right? Like if we think about it in the context of the COVID arbitrage, that same arbitrage was not available. We didn't have the everything goes online, CPMs are lower, let's just
Mhm.
spend into it. And so if you're trying to comp up compared to the previous year being 2020 and you're a brand in 2021, you know that your new customer acquisition is going to have to increase given the different environment that you're in. What I think the data shows us is that brands did not have as much discipline in growing their new customer profiles during that year and rather took the growth from their returning customer splits. So they took all those new customers in 2020, realized the value of them over 2021, which made the year over year comps not look as bad, actually. Like the year over year comps were pretty good because all the new customers in 2020 brought returning revenue in 2021. But now in 2022, there's not a lot left from them. And there has to be another time period of filling that sponge back up, of bringing in those new customers, because those new customers back in 2020, they're not there the same way that they have been over the past 12 months, 15 months.
Yeah. So we're seeing, yeah, essentially the fallout from, this is a mixed metaphor, but the fallout from the massive wave that was COVID 3 years ago, right? Or the splash or whatever
Yeah.
it happens to be. Because, I mean, that was massive. And the initial take on that was ecom is going to be, we're going to be in the black forever. And then, of course, that didn't happen. And so now the numbers that we're seeing in 2023 are directly related to what was happening in 2020. One thing that I think is interesting to point out from what you said, or to draw out for our listeners, is we talk a lot about poor short-term decision making based on having to hit your monthly revenue targets. But then, of course,
Yes.
we don't talk much about setting, or we do talk about it a little bit, but we haven't touched as explicitly maybe on setting your monthly revenue targets realistically and not based on purely on year over year comps. I think that there's definitely like a very human way of saying last May was this. If this May isn't better, then what are we doing? And it's our fault or
Yes.
whatever. And of course that there's things you can do, but there are certain economic realities that actually cause you to make poor decisions if you are attempting to exceed last year's goals, right?
That's exactly right. And just to give the benefit of the doubt to a lot of us out there, executing on the daily and monthly timeframes, there some of those decisions are there's constraints around them, right? Real
Yeah.
cost constraints. And so if you're wanting to see year over year growth in revenue or achieve a certain, bottom line or top line number, and in a year like 2021, you're seeing higher CACs, you're seeing higher cost of delivery, right? None of that has changed. Then there are some constraints where it's like, hey, maybe this is a time period where we need to cash in some of that returning customer margin that we've accumulated. And that's fine. There's
Mhm.
time periods for that, right? Like this is the whole idea. What is the time period in which we're trying to maximize value or profit? Many brands chose that to be during some months in 2021 and into 2022. But now you don't have that option anymore, is what it's
Right.
coming down to. You don't have that to fall back on, given what we're seeing in the broader data set.
Yeah, it's also worth pointing out too that like it's easy for me to say from my vantage point or whatever, not being on growth teams, for instance, and looking back to sort of think of those decisions as panic decisions or whatever, or poor decision making or whatever. But a lot of the time, you're making a survival decision, in which case, yeah, you have to maximize revenue over that monthly target, and if you don't, then you're out of business. And so, of course, like that's going to happen. But like again, like you're saying, that's not really an option anymore, or the landscape has changed dramatically. So let's talk a little bit then about what, I guess, yeah, let's talk about like what action steps brands ought to take. What is that new reality? And if that's not an option anymore, what are the options available to us?
Yeah. So what we're seeing is, yeah, that your growth in returning customers fell off a cliff. We're just not seeing that support anymore. And so if brands are in a place where they want to achieve any top line growth, and the returning customers are flat, or for many brands, they have returning orders where, you're 10, 20% behind last year, potentially, you're already in a negative position. Any top line growth is going to have to come from new customers, right? Your returning customers aren't there. If you want to achieve top line, that's going to have to come from new customers. So let's talk about that first as scenario one. And then there's another second scenario we can dive into. What brands should expect, though, is if you're wanting to grow top line and you need to do that by increasing your new customer efforts, there are additional cost considerations, particularly your CAC, that come into play. So you have to, whereas your returning customers, you don't have to acquire them again for your new customer revenue. You're going to have to pay that customer acquisition cost. It's going to increase the overall cost of the business. EBITDA is going to go down. Yeah, the overall bottom line outcome of the business is going to look rougher. Your MER is not going to be in as strong of a place. And as an example, if you're a brand that wants to grow 10% year over year and your returning customers are flat, that means your new customers, if you're at a 50-50 split, will have to grow 20%. If you're at, exactly half between new and returning customer revenue contribution. But what we all know is that CAC goes up with spend, right? So you're not just going to spend 20% more to get 20% more revenue. You're probably going to have to spend 30% more, maybe 35 or 40%, because your CAC is going to go up as that spend escalates as well. So if you're in a position wanting top line growth, certain number, there's a certain outcome that stakeholders or investors are expecting from the brand, that's what the business needs to expect, is lower bottom line outcome in the near to midterm, higher CACs as a result of spending into that, because your growth is going to have to be driven by all new customers.
Yeah. So maybe that's a good way to segue into thinking about if the sort of traditional, all of the traditional growth metrics, if the expectation is going to be that they're going to be lower, like we're going to see MER come down, we're going to see CAC go up, we're going to see your growth go down, like all of these things are going to be trending downward, then what's the metric? What is the sort of North Star metric we should be looking at then? Like, where are you going to measure success? Because I imagine it's different than saying, and maybe it's not, you can tell me, like, hey guys, we're going to target a worse MER this month. Maybe not specifically that, but so what should the new North Star metric be then?
Yeah. So the good news that we're seeing so far this year is that we started to see a growth in new customers for Q1 of 2023 compared to last year. So that's the trajectory that brands want to see across our data set. We're seeing Q1 of 2023 about 20% growth year over year in new customers. So ultimately, that is the focus. We need to add new customers to our customer profile, and we need to build that back up. The constraints or metrics that any given brand focuses on to get there, I think really, especially in this environment, will be dependent on the cash position and capitalization position that those brands are in. So like we've been having more and more of these conversations this year where folks are needing to find additional margin within their business in order to support that new customer growth or that acquisition to build their position back to a healthier place. And I think we're seeing this across the board, right? With all the tech companies, Snap, Twitter, Meta, and the rounds of layoffs and the places that just the costs are being sought out in general. And so I think that is what it's going to come down to, is understanding what sort of cash position are we in and what profitability do we need to realize in a specific time frame in order to not die, in order to get to a place where we are sustainable. Because we'd love to say, hey, go acquire as many new customers as you can every month and spend to the moon to achieve that outcome. But there is a time constraint against that. And for a lot of brands, that could be, every given month, they need to see X amount of profit realized in order to sustain their operations and support the life of the business to the next month. But I do have specific ideas on metrics that can be identified and executed against, but I'll stop there. I think that's the general thing to get clarity on.
Right. Yeah. And I think like we talk about it on the podcast anyways, like as a general rule, and this is just, this is sort of a CTC philosophy, let's say. As a general rule, you should be trying to take the lowest, or rather the least efficient acquisition cost, I guess you could say, still responsible, right? That is still makes
Yeah.
sense given your cash position, because that's the way to grow, essentially. Like, so you shouldn't,
Yep.
obviously, like, the general advice there is to not try to balloon efficiency for the sake of it. Like, you always want to keep it, generally speaking, as low as you can, as long as you're growing the new customer or file, and you're not
Yeah.
endangering your business, right? But in this case,
Yes.
that you have to do that, right? It's not,
Hmm.
like you were saying before, it's not optional anymore. This is the reality. You can expect, and you should be planning for, lower efficiency anyway. So make the most of
Yeah.
it and make sure that you're acquiring new customers at the rate that you need to.
That's
Cool.
exactly right. Yeah. And I think in recent years or even recent months, a lot of brands would have been more open to executing against maybe a 60 or 90-day break even, right? Hey, let's
Mm-hmm.
push growth and we can realize the value of those customers over a longer time period because we have additional capital to support the acquisition efforts, whatever it may be. Now, I think to your point, every new customer acquisition dollar that is that produces positive margin for the business, that's the level where it should be pushed because new customers need to be acquired at as high a rate as possible without getting margin deteriorative on those acquisitions. So it really is identifying a CAC against our cost of goods, against the cost of delivery, all the variable costs that go into it, and understanding, okay, what's the most amount I can pay for a new customer that they where I'm at break even on the first order or producing X amount of margin based on whatever my cash flow needs are, and then push against that line because this quarter's new customers are Q4's revenue in the same way that last quarter's new customers were Q2 and Q3 and Q4's revenue as well. And so the outcome for brands in the second half of this year is really going to be based on how they're able to execute and acquire new customers during this coming quarter.
Yeah. Okay. So speaking of that execution, you sort of teased us a little with some specific ideas that you had around guardrail metrics and other ways to sort of bring this about responsibly, let's say. So why don't we get into those? Why don't you break down some of those ideas that you have around how to actually execute this?
Yeah. Yeah, for sure. So I think, and this will be a good way as well with the diagnostic toolkit. I don't know if there's more context you want to give there, but there's some specific metrics there that I think are the parameters and focus areas. And so I can sort of start with the first one, which I teased, which was first order value to new customer acquisition cost ratio. So your FOV to your end CAC, right? And that's really understanding how many profit margin dollars, right? Not revenue, but what is the profit outcome I'm getting from a first time order against my CAC? And you want that to be in a place where it's producing positive margin dollars, right? Ultimately. And I think that's the main guide rail to have into place first, because that's going to be the definition of success that trickles down all the way to your specific paid media channels and the targets you set on those. And we can get as tactical in talking about what that looks like to set a Google ROAS target based off your first order value number. But ultimately, we have to have a definition of success, and I think that should be what is the CAC that I can go out and acquire against that's not going to deteriorate my business's margin this month.
Yeah. So let me break that metric down a little bit more. So first, FOV to NCAC is first order value to new customer acquisition cost ratio. And what first order value, what that number includes is it's AOV, right? So it's the actual revenue that you receive from a first time customer. But then it's that number less COGS, or rather, sorry, cost of delivery, which would be COGS, tax, shipping, any expense associated with getting the product to the customer, right? And then that we subtract CAC from that number as well. So you have AOV minus cost of delivery minus CAC divided by CAC equals your FOV to NCAC. And what you want that number to be is greater than zero. So if you've already run the diagnostic toolkit and maybe you've seen that you have there's a bigger negative effect on your growth quotient score, let's say from something else, but this number is still sub-zero, it's still in the negative, this is actually the place to focus on right now. Because if that number is in the black, then you're probably going to be okay in terms of new customer acquisition. So you have to figure out like where that balance is, so that number is always staying in the black, right? So we can get into then if you want to get into some tactics. I'm sure we would appreciate some tactics. So, what are the specific things that you're putting in place now to protect that FOV to NCAC ratio for your clients?
Yeah. So I think there's two things. One is on the daily execution in our paid acquisition channels, and the other is a full P&L view of the business. And maybe we'll jump to the full P&L view and what that looks like. But first, to speak more tactically to the paid channels, what that entails. So ultimately, we want to hold that whatever our target is for our FOV to NCAC, we want to hold that expectation on a daily basis. We need to have a plan for what we're setting out to accomplish in the month. We need to break that down, not into just to a monthly target, but a daily target. And then we need to have channel and campaign specific targets that ladder up to that. Because if we're violating that on any given day, then we have to dig ourselves out of the hole the next day, right? If you're negative on day one of the month, that means day two of them, you have to be even more efficient than you set out to be. And that's harder than ever. You're probably going to have to spend less, and it's just going to perpetuate the cycle. You can't get behind. Identify what that ratio is, and then break that down into a volume constraint as well, right? Because this ratio is a helpful efficiency constraint, but for many brands, there needs to be a total profit dollar expectation in the month as well, because
Mhm.
there's rent to pay and there's overhead and everything else that goes into the operating costs. And so I think a really helpful starting place is start with what is the returning customer revenue that we can expect this coming month? What's that foundational returning customer revenue, right? Like we talk about at CTC, the layer cake. Start at the bottom. That's the most predictable. That's going to get you to a place where you can understand, okay, this is how much revenue I can expect from my returning customers. You can less your cost of delivery against that revenue, right? To basically get to a returning customer contribution margin expectation for the coming month. This is how much contribution dollars I can expect from my returning customers. The hope is that can at least cover your fixed costs for your business to support you in the coming months. Because what that does is it doesn't put as much constraint on your first time customers. Now, for some brands, that won't be possible, and they'll say, "Okay, we can expect this much returning customer contribution this coming month. Our expected costs are actually higher than that, and so that delta is now what we have to go out and get from our new customers, right? So get clarity on that number. What's the new customer revenue number? Is step one that we need to achieve. That's going to make sure that we continue to operate the business over the time period that we're hoping to operate it at." Then you have new customer contribution dollars. That's what I'm going after this month. Now we can start to think about where to get that from each of our specific channels, but we're holding to not just an efficiency constraint, a volume constraint as well. That's going to make sure we get to the total bottom line profit and EBITDA number that we need to achieve.
So those are the tactics you're employing right now, but you also had some ideas around incremental strategies that you can put into place, particularly around like, let's say operational costs, expenses more generally. Break some of those down for us.
Yep. Yeah. So you have clarity on returning customer contribution, what that's going to be for the coming month. Then you have clarity on new customer contribution, how much you need to achieve in terms of profit dollars from new customers. And you have your FOV to NCAC to go and execute against on a daily basis, right? We're going to spend against this number. We're going to acquire as many customers at or above that efficiency ratio for FOV to NCAC. Now, what are the other things we can do to increase our outcome? What are some incremental strategies that will get us beyond that projection, right? Because that's sort of the baseline of what we're hoping to achieve. So I think we can kind of go down the line here. Maybe let's start top funnel and then work our way down sort of towards the bottom of the P&L. First percent organic traffic, right? Like this is, we're thinking of new customer acquisition being the main focus and wanting to do that in the most marginally accretive way. Increasing the new customers that you're acquiring from non-paid channels will be really helpful for that. This has a longer tail. And so that's why I think when we're thinking about prioritizing these things, first setting the constraint on efficiency for paid channels and executing against that is the main priority. And then focusing on, organic new customer acquisition strategies, because many of these have longer tails where you may not realize the value the next month or two. But starting to build those blocks for the coming quarter will be really helpful. So that's really thinking about, like, when I think about driving organic new customers for brands, there's so many different strategies that come up, right? Oh, should we be doing affiliate? Should we be doing influencer? Should we be doing PR? Okay, how about different blogs, right? What's our SEO presence like? And the brands that I have seen drive substantial organic new customer contributions to their growth focus on one or two organic strategies and do them really well, which is actually what we say on the paid side of things.
Yeah.
Focus on Meta and Google and do them really well. That can get you to a really big revenue number. And that should be the same thing on organic. Not, hey, let's dip into making some blogs. Let's maybe do some influencer seeding here. What we should do is take a step back, identify what our strengths are as a brand, what our strengths are as a team, really the skill sets that we have, and where our customers are at. Where does our audience interact? And then build our organic channels from there. So I'll give like two very different examples in terms of brands that have done organic well. One was a ring company that I worked with back in the day. So engagement rings, wedding rings, etc. Our you they're a demand creation, demand capture. They fall more in the demand capture category, right? You're not going to market someone into thinking, oh yeah, I need an engagement ring. It's very need based at that moment for where they're at. So that's one thing the brand identified. Another item is the team at this particular brand had a really strong coding skill set. So really just had expertise in development. That's what the founder, his background was at. And so they identified SEO as the main organic strategy they were going to go after. And it was very substantial for the business. They had various blogs on lab diamond versus natural, ring sizing, all those different things. And they owned some of those key terms and did it really well. They didn't do influencer. They didn't do affiliate. They didn't do these other areas and they focused on that. And then on the other side of it, a brand that I've seen get strong organic contribution from as well does so through influencer and PR specifically. And so their product, footwear brand, high fashion, and their customers are on social media a lot and post their outfits a lot, right? What they're doing throughout the day. And so that made sense to them. And also, that brand had some strong connections within the PR space from their prior background. So when thinking about organic channels, that's what I usually like to start with and thinking through is not so much, hey, here's, the five main organic strategies. Let's kind of dip into each one. Who's going to own this? Okay, let's go execute. But hey, where does our audience hang out? And what is the skill sets within our team that already lend to one of these organic strategies and just start building from there. So that's where I'd start on organic traffic.
Yeah, that makes sense. And yeah, I think that there's also sort of an intuitive understanding of your product and how it would work in organic spaces as well, which is really important. That particular footwear brand, it's lends itself to people photographing themselves in the product. Whereas there are other
Yeah.
apparel brands where, let's say that you make, I don't know, gray t-shirts for the gym or whatever, that same strategy won't work at all, even though you're technically in the same vertical. And so there has to be some understanding there of like, hey, given our skill set and what our product is, these are the one or two things that we should focus on right away, basically.
Yes. Yep.
So yeah, anything else specific to incremental strategies that you think would be worth hearing?
Yeah, so we're starting sort of top funnel here and moving our way down. A number of revenue peaks. I think this is a really good opportunity for brands to take a step back and assess their marketing calendar and think about moments that they can take advantage of that they currently aren't to drive new customer acquisition. Brands have to be careful because especially in this environment where, as we talked about, MER is going to be lower, profit is going to be a bit rough. You don't have that contribution room from returning customers. The initial lean is going to be into discounting and just, hey, let's run a sale as our
Mhm.
next peak. But really thinking about what are some moments that our brand can align with to create a new peak for a new customer acquisition. Really good time to do that as well. And then I think as we move down from top line revenue to more cost related metrics, cost of delivery and operating expenses, there are most likely opportunities hiding in both of those still for any given business. It could be incremental and pretty small in the impact. It could be substantial, but as CACs continue to increase and returning customer contribution isn't there, every additional percentage point, half a percentage point in cost of delivery, every additional expense, monthly expense on your OpEx that's eating away at margin is going to be super helpful. And so that's a longer exercise, of course, of really getting real with, hey, what are the expenses that we need to continue to maintain, and what are those that we should consider cutting for the long-term health of our business. We're having a lot of conversations about that currently, diving into P&Ls to understand what's needed, what's not, and what can be adjusted. And then I think finally, we've been sort of messaging returning customers are flat. The sponge has been squeezed. And so this point is going to go slightly against that in the sense that there is probably opportunity within your returning customer base still, but not in the way that you have been going about extracting that value. A different strategy, an incremental strategy. And so when we think about returning customers can be broken into a number of different segments, right? It's not just all returning customers. How we think about them is returning customers that are active, those that are at risk, and those that have completely lapsed and then churned finally. So those four main categories. And within StatList, we have a distribution of where our current returning customers lie within each of those segments to identify over time. But most likely your current returning customer strategies are lending to one or maybe two of those four segments. And there are some at risk or lapsing customers that need to be spoken to differently or need a different offer in order to convert again. Or maybe there's churned customers that have fallen off certain campaigns and flows, where if you think about a strategy for those customers specifically, there is additional value as well. Again, we talked about this last because it should be the last focus. Growing that new customer portfolio is really the main goal, but there is most likely opportunity within the returning customer profile as well. It just has to be extracted in an incremental new strategy compared to what you're currently doing in order to realize any outcome from it.
Right. So maybe another way of putting it is that not all returning customers are created equal. Many of them are at, let's say, different points in their own customer journey. So one thing that won't work is not really doing anything and hoping that they return, which is often the way it goes. And finding those that are basically about to dip, figuring out what they want, how they need to be messaged, and then bringing them back into the fold, which is obviously the way that you grow that bottom layer of the revenue layer cake and support all the new customer acquisition that you're going to need to do.
Yes.
Cool. So I think so then if we can wrap this all up, what would you say the headline here is? Let's summarize it.
The main thing to keep in mind is that returning orders are flat year over year. What that means is there is going to be additional cost constraints on any brand that is wanting to achieve top line or bottom line growth in this first half of 2023. That said, brands are going to need to take the hit in the short term to realize growth and build their business back to a place of health in the mid to long term. So there's a short term trade off here for a long term payout. Most brands realized the value of their customers in 2020 over the course of 2021 and 2022. And that was fantastic. That was a great time. We all enjoyed it, but the music has stopped and we've got to build back those new customers to get back to a place where we're realizing top line and bottom line growth over a longer time period.
And if you want to know where you stand relative to those metrics and what you're going to be needing to do, the e-commerce diagnostic toolkit, which Luke and I have been talking about here, and which is those metrics that you were talking about in terms of incrementality, those are all from the diagnostic toolkit as well, in terms of assessing your costs relative to where they need to be to get a positive FOV to NCAC, or rather to assess the FOV to NCAC you'll need to hit. Those are all in the e-commerce diagnostic toolkit, and you can figure out exactly where you stand relative to those metrics in order to make these big decisions over the next few months. The discount code POD197 is still available to our listeners. You'll get $100 off the current price if you want to go ahead and use that. Luke, is there anything else that you want to hit before we head out here?
Go get those new customers. We're all doing it.
That's right. Go get those new customers. We're all doing it. And if your MER numbers are down, don't feel bad. All of ours are. That's just the way it is right now. Luke, appreciate you coming on. Appreciate your on-the-ground insights I think that's something that all the folks appreciate. We'll have to have you back, but thanks for coming on, man.
Absolutely. Thanks for having me.
Hey, folks, thanks again for listening to the e-commerce playbook podcast. Again, as I mentioned, use the code POD197 on our site, commonthreadco.com, to get the e-commerce diagnostic toolkit for $100 off of our regular price. That's still available. That will be available for our podcast listeners for the foreseeable future. Again, we appreciate you guys listening. If you have any questions or comments, go ahead and email podcast@commonthreadco.com. We would love to answer your questions on air if you have them. So again, thanks for listening. Happy scaling, everyone.